Welcome back, everyone. It's Paul Meeks here. Today is Tech Tune-Up. I'm your host, always in conjunction with my buddies at Benzinga here on their YouTube channel. Make sure you like and subscribe to us. So today is Friday, May 16th, and earlier this week on Tuesday, I had a full right hip replacement. So if I fall out of my chair and start screaming in pain, you know what's going on. But anyway, I appreciate the opportunity today to at least flex my brain and get back to the markets and share all that with you. So start to think of some questions that you can ask me at the end of this program. We typically go for about a half hour, but now let's get to the tech stock news and delve into the ramifications of some of that news. So let's start with one of my favorite plays that I've talked about for a long time, even when I invested in it as a public or private company before they went public just a few months ago. This is the New Jersey-based AI cloud company called Corewave, symbol CRWV. Today, the stock is up 24% to about an $82 handle. I do not know why, but I was pretty bullish on their first quarter that they reported as a publicly traded company a few days ago. This company is a little confounding to some because here's what they do is they sign up a customer to essentially rent their AI data centers, and they have to go out and spend big on capital expenditures to do that. But each one of these build outs, regardless of how expensive it is covered by the revenue of that contract. So they get success with a contract, then they build the data center. In the meantime, it seems to freak people out. The capital expenditures are high, the debt is even higher, but I still think that this stock, maybe not a buy, up 24% today. I'm in the stock at 48. It is up over a double from its 40 IPO just at the end of March of 2025. But I'm sticking with it, and hopefully it continues to rock for you, me, and all other investors. I thought it was a very interesting sign, even though I don't have a position in the name, that eToro had such a strong IPO. Now we're a couple of days after its IPO and the stock is giving up a little bit. No surprise, that happens every single time. But we had another tech or tech-oriented IPO that was oversubscribed, that popped on its first day of issue. And so that's not only a good sign for eToro, it's a good sign for investing in my entire sector. So we did get a little bit of a lift this week. You know, our buddy Trump is in the Middle East doing Oprah Winfrey style deals with anyone and everyone, which is obviously good for America, but particularly good for some of our semiconductor companies like Nvidia and AMD. They are going to sell to Humane, spelled Humain, which is a subsidiary of the Saudi investment fund. They're going to sell them a hell of a lot of very sophisticated, very expensive, very profitable AI chips. So we did see some pushback, maybe some potential weakening of demand, being hurt by tariffs over at Nvidia and AMD. And at least this is new business and very high margin business and can skate through the regulators and the tariffs for those two companies. As you know, Nvidia has never gone off of my buy list. It's still on there. I'm warming up to AMD a little bit, but I still prefer, with its probably 18-month lead in technology, Nvidia over AMD. So next, I should probably delve into NRG Energy. We all know that these AI data centers have a voracious demand for energy. Now, Google, for example, has done deals in the nuclear space to gather that energy. I still think, at least for the next couple of years, the way to play this is through natural gas companies rather than nuclear companies, because the nuclear companies, their build-outs are very expensive, and their build-outs are many years before they're actually producing energy. So NRG announced that it's adding to its portfolio of nat gas capabilities, which are going to be steered toward AI data centers. That's a stock that's not on the list right now, but it has been on my list in the past. And again, I continue to like nat gas in the short term, intermediate term over some people that have driven these nuclear stocks way too far, too fast. So next, also a very good indication for tech center investors like us, Perplexity AI, which is a private company, is doing a $500 million money raise right now, which values the company at $14 billion. And I think the company was only valued at $9 billion a few months ago. So you're seeing that there probably is some truth to the fact that in the future, you will be doing more what I like to call zero-click search versus your traditional search through a web browser like you get with Google. So this is a real threat to Google. And this could create, whether it's Perplexity AI or somebody else, a real major combatant in search through these AI capabilities. Stay tuned, stay on top of, get ready for the IPO of Perplexity AI. One of the things I think is interesting is OpenAI, obviously another mammoth privately held company in this space, announced that 1/3 of US corporations now have a license to OpenAI chatbots. So the initial ramp was through the consumer. And now, if they're telling the truth, and I have no reason to doubt them, if they now have 1/3 of US companies subscribing, not just, playing the game for free, but actually subscribing, that's a real good monetization and a real good sign for OpenAI. So we'll see. Next, I want to talk about Cisco. When I was a young analyst, I started covering technology almost exclusively in 1992. I went to grad school, Kellogg School in Illinois, between 90 and 92. And there, I actually gave a presentation for a public speaking class on Cisco. And it ended up being a great stock pick, even though that wasn't my angle back then. And so, Cisco was the data networking company to the stars during the internet bubble. It was at least America's, maybe even the world's largest market cap company back then before it imploded like everybody else did during the internet. And so I once knew the company intimately. Of course, I follow it consistently all these decades. But I must say, the quarter that they just put up with the revenue growth acceleration, I was very impressed with. And also, I talked about this company, Humane, which is buying all these what we call sovereign AI chips from Nvidia and AMD out of Saudi. They have connections with Cisco too. So if you could imagine this old school, almost given up for dead tech company comes back on the scene in AI, that would be really, really impressive. I'm not sold yet, but I tell you, I followed their quarters for years and they showed me a something. So now I'm going to probably look to buy Cisco on its next dip, because I never buy stocks when they're flagpole moving straight up. Coinbase, Coinbase had a very serious cybersecurity attack. And this is interesting that the bad guys are holding them ransom for $20 million. And the company has said very publicly that they're not going to pay the ransom. This will be a very interesting test case for how we unfortunately have to interact with these cybersecurity bad guys. So stay tuned. Coinbase is a pretty good company, has pretty good prospects. If this stock gets whacked too much on this news, I'm probably a better buyer, but I think it's more interesting as a test case for, do we have a company that finally will not meet the demands of some of these cybersecurity sleuths? We'll see. Meta. Meta is, and it has been for some time, among my favorites in the Mag 7. However, I was a little bit disturbed because they've announced that they are going to delay the release of their behemoth large language model. That's their next latest and greatest large language model. So shows you that this stuff ain't easy. even with the resources that Meta has. But again, they will conquer this space in the future. I have the most confidence among the Mag 7 that there will be big players here. So even though we've made a lot of money on this program, just holding Meta and actually focusing on it versus some of the other Mag 7, I think we have a situation here where any bad news knocks down Meta, we might get a chance to either initiate a position if you don't own it, or to add to positions like I plan to do. Next, I want to talk about, and I don't want to talk too much about it, the big cable merger. You know, Cox and Charter are going to merge. And what I say is two bad things don't make a good thing, right? This is a dying industry, cable television. These are companies that are subscale, floundering. Do not think that this is going to be any sort of a catalyst. I still would probably short the entire cable TV industry. And then every time you want to get into media, just buy some more damn Netflix, almost at any price. So I'm poo-pooing, no surprise, on that yesterday's merger of two cable companies. Next, Foxconn. Foxconn is the Taiwanese company that manufactures a lot of consumer electronics, and particularly a lot of consumer electronics for Apple. And they just announced their quarter, and they gave, when you peel back the revenue by segment, they gave a very, very strong forecast for their own build out of AI servers that populate these data centers. Now, this is a good and a bad thing. It's a good thing for the entire industry because it shows you how robust the growth is. But it's a bad thing for some of its competitors, which are Supermicro, Dell, and Hewlett Packard Enterprises, HPE, because Foxconn comes to the dance very happy with very, very skinny profit margins. They live with those margins. They love those margins. And when they come in and they start to squeeze the margins out of the industry, there could be some hell to pay for the US companies that don't survive that kind of regimen. So we'll see. Netflix up next. You know, Netflix announced that its ad supported tier has been growing like a weed, much faster than analysts like me had expected. And of course, this is an important growth driver, but it makes me think that Netflix lead over the other combatants in this space, particularly video streaming, is lengthening, not shortening. And of course, Netflix has been a great pick for us here on this program. But I will tell you, on the next dip, maybe not today, maybe not tomorrow, but on the next dip, I really like the momentum. And what I see is continued momentum coming out of Netflix. So next, this is a very interesting announcement. It's going to be a $4 billion US capital expenditure spend by Global Wafer. Global Wafer is another large company out of Taiwan in semiconductor manufacture, not to be confused with the US company called Global Foundries. This is Global Wafer. But yes, under pressure from the Trump administration, the same cast of characters are moving their manufacturing operations to the States and to, under pressure, produce chips here. And this is a good thing. But remember, the incremental manufacturing is not coming from a US company. The big players in the States, even though they will be in the States, and hopefully they hire Americans at their fabs, will be Samsung, which is South Korean, and TSM, which is Taiwanese. You know, this Global Wafer is kind of like a minor league player. Next, T-Mobile. T-Mobile has come back a little bit recently. And you know, I like this as a what I call a defensive tech name or chicken shit tech name. The stock has come down considerably because when they announced their quarter last week, and I reported on this, they did miss their net subscriber numbers. However, I think the stock is overcorrected. It is oversold. And I plan to, and I hope you consider too, if you don't own it yet, buying T-Mobile when it successfully tests its 200-day moving average, which is about $229 per share. Next, Alibaba. Alibaba, unfortunately, never has a clean quarter. They have like certain aspects of their business that are great and other aspects of their business that falter. I wish they would get it all together in a single quarter, but that's probably too much to expect from these guys. However, Alibaba had a poor quarter overall, and the stock came down immediately 6-7%. But I will tell you, their AI business is very strong. I think they will be the lead player in China, which is still an important market in AI. And as long as that business is still strong, which it was in the quarter just ended, I would continue to add to Alibaba positions. And then the last stock I'll mention here, like I have to mention essentially every time, is Apple. So Apple is now getting pressure from President Trump to not only move its manufacture of their iPhones and other consumer electronics from China. Now they're getting a little pushback because they want to move from China to India, not China to the United States. So here's the bottom line. I don't want to spend too much time on this. Not only do I worry about Apple's top line growth, right? They thought that AI on iPhones was going to lead to the mother of all iPhone upgrade cycles. It never did. And so it's still revenue challenged. Company hasn't grown really for 4 years. But also, no matter what happens with all these puts and takes with the tariffs, whether we move from China to India to manufacturing iPhones in the States, whatever way this plays out, it is going to considerably, no doubt about it, add to Apple's manufacturing costs. And so they're not only going to be pressured on the top line with revenue, but their costs are going to go up considerably, and it's just a matter of how much. And so it continues to be one of my names to warn about within the Mag 7, where if you listen to a lot of tech forecasters like me, some of them still love it. I do not, and I have not for some time. So now let's take a look at some of my stock picks. So here's my list. The green are fresh money buys. The yellow are stocks that I have some interest in, but they're waiting in the bullpen. Either it's valuation or I need to see another positive fundamental catalyst, or if it's technical analysis, I'm looking for the right price point to either buy a company fresh or add to current positions. But I will tell you, as you scan through this list, after they reported the quarter, which I announced about a week ago, I think my favorite tech or techish stock right now is AppLovin. And it's a stock that people poo-pooed on until they had a nice quarter just days ago, and they've started to turn it around. I never really had a doubt about their fundamentals, but some people did. So I would say my strongest recommendation for a fresh money buy, because frankly, some of my stocks that I've talked about here on air have already done their thing, and there may not be that much upside left. But AppLovin right now, highest potential upside of any of my stocks that I'm willing to buy today with fresh money capital. So you see that my list is still, because I still am worried about overall market conditions, it is a mix of aggressive tech favorites, though I've refined that list, even within the Mag 7, and some defensive plays, which are the other end of the ballast on the ship, trying to steady out a aggressive growth stock portfolio with some other companies that have good prospects, are growing, but they're much more defensive. So not really any changes there, but I will say that this probably leads into an overall comment that I should make. The reason I still have this mixed portfolio, including a couple of stocks like Duke Energy that are utility stocks, not even tech stocks at all, is because we have had a crashing in these tech stocks ever since April 2, Liberation Day, when Trump first announced the tariffs. But here we are now in May 16th, and we've had essentially a V-shaped recovery where we've come all the way back to that high water mark. And so now the S&P 500 is about flat for the year. Would it have been brilliant to get out of all your stocks on April 2nd? and then buy them back at the trough to have this rebound, impossible to do. But since most of these tech stocks, even ones that I like, have come back so far so fast, I still have this mix and a defensive portfolio with, mind you, quite a bit of cash, because I don't think that this rally can stick, right? There are too many worries. We still have a lot of work to do between now and when the 90-day tariff extension ends on about July 2nd, unless you're Chinese tariffs, and they could be pushed off a little bit longer with the latest deal. But there's so many ifs. And I think the market has reacted to that this is all behind us, this tariff madness. I don't think so. I don't think so. And so I want to be super cautious, even though I'm coming back into the tech sector selectively. So now let's talk a little bit more about some tech trends before we get to your questions. I continue to watch rates because I continue to be convinced, you've heard this from me many, many times, that unless we have rates steadily falling, we do not have a good enough backdrop to continue owning a whole dollop of aggressive growth stocks, including tech stocks. And if you take a look at the CME FedWatch tool, it looks like the conventional wisdom is that the Fed will not lower rates until the September meeting. At the beginning of this year, before Trump was inaugurated president, the same cast of characters on Wall Street thought there were going to be at least 5 interest rate deductions this year. Well, we're not going to get to the first one, and that's a maybe, until pretty deep into September. That continues to worry me. And of course, the Fed, particularly Jay Powell, the chairman of the Fed, is as confused as we are about what's going to be the ending impact of the tariffs, right? The tariffs probably are inflationary because they will raise costs for U.S. companies and consumers. And they should lead to slower economic growth than otherwise would be the case. We call that stagflation. That ain't good. And unless things change, materially for the better, I don't know if we've even seen the evidence of that yet, because we have come through a pretty good quarter for most of my tech companies and other companies reporting their earnings for the period ended March 31st. But you think about it, we did not have Liberation Day into April 2nd. So that missed the entire quarter. So it's kind of like that's rear view window. Who cares? We're going to see the tariff impacts this quarter. So let's stay tuned to see what the tariff impacts are. And we won't hear that until about the second or third week of July after they reported the quarters ended June 30th. So it's still too much to tell. And I think the Fed's doing the right thing. They're being cautious. They probably want to see that same data dump as I do. In the meantime, they're kind of stymied. They can't lower rates, and we need them to lower rates. And please don't give a whiff that they're going to raise rates to fight inflation, because then all hell will break loose in the market. So I continue to watch that. Again, I can't answer the question. Fed Chair Jay Powell can't answer the question. I don't even know if President Donald Trump could answer the question right now. And so has me in that kind of, I know it's a little bit bullshit, but a mix of aggressive growth stock tech companies and some of my defensive names like a Duke Energy. So one of the things that is positive, I'm happy about, is if it was not confirmed by the Trump administration, Biden's diffusion AI rule, which is going to have pretty serious impact on the number of chips that Nvidia and AMD and others could sell to foreign countries, that was about ready to go into effect on May 15th, right? That was yesterday. And luckily, it was unraveled, canceled, postponed, whatever you want to call it, by the Trump administration. That is a very positive read for tech, particularly the semiconductor industry. I still look for more and more AI use cases to make sure that at some point we justify with a monetization of some of these apps, all these hundreds of billions of dollars that we have spent on AI-related capital expenditures. So the de minimis provision was halted. I talked about that last time. De minimis provision was, at least when it was good, we had a situation where if you're Chinese and you ship something to the States that had less than an $800 value, you could skip the tariff and other charges. Well, that has been cut back. And so either it's off the table, maybe it's part of this next round of negotiations with the Chinese, but at least right now, not as onerous as it could be. So just before I get to your questions, I've been on this buyer strike. I've said it many times, right? Probably for a couple of months now. I am gratified that some of our favorite stock picks have had huge rallies off the bottom. However, I'm still worried that even for my favorite names, that those rallies may not stick. I think it's too far, too fast, because we haven't seen the impact of tariffs yet on these companies and more broadly the US economy. However, I am feeling better about individual names, so I'm rifle shooting. I'm not shotgun shooting. I don't think the tide is going to lift all boats. I think the tide is going to sink most boats. But I have been putting money to work on those stocks, particularly that are shared on this program in bright green highlight, which is my buy list. So I'm backing off from a aggressive buyer strike. I'm buying a little bit more, but I am not as bullish as some people in the market today seem to be. So with that, those are my remarks. Let me answer a few questions. All right, here we have a question from my buddy Rich. Talks about Tesla, and the stock has had a huge rebound. I will tell you that the rebound is all based on what they say they're going to do with robots and autonomous vehicles. If you own Tesla, because their core EV business is probably going to have a very weak year, and I'm not so sure, as with any Elon Musk announcement, if they're going to be on time or if things are going to even happen at all. But if I were you and I was long Tesla, I would probably at least take some profits, maybe not sell it all into the strength, because you think about it, the stock is way up based on cooling some of the relations with the Chinese, based on the soon to come, hopefully for them, autonomous taxi and robots. In the meantime, nobody says that their EV business is great shakes. It's actually really deteriorated. So if all that stuff is already baked in this current stock price and it's popped so much, I'd probably begin to sell a few shares. I definitely wouldn't buy it fresh. What about Lam Research? I admire Lam, though right now I'm not really bullish on too much exposure in semiconductor capital equipment. My go-to in that space for many years, just because it has an unsaleable technology position, is ASM Lithography. Of course, that's a Netherlands-based company. It's not a US company. I was a little bit worried about recently what Applied Materials had to say about the space. And so I would go with other tech names over semiconductor capital expenditure companies, and even including Lam, which is a company I do admire, but I always prefer in that space ASM Lithography. All right, guys, I wish you a very happy weekend. Please send me some love on this hip replacement. I hope to be walking at least with a cane by Monday. That's my goal. And stay tuned. I'm always going to tell you the truth. There's some really positive things going on right now, but I think the market is ahead of itself because there are still some negative things that are still to be unanswered. So I will see you guys next week. Be well.